Everyone, welcome back. Today we'll be understanding a very important topic and subtopics related to Monetary Policy Committee. So, as I promised last week in my last video, we have come up with a very important topic, which is a Monetary Policy Committee. And before jumping into the Monetary Policy Committee, we'll try to understand what an inflation targeting is. Inflation targeting, in general term, is nothing but it is an announcement of official range of target for an inflation. It is generally done by central bank in an economy in order to realize the objective of a stable rate of inflation over the years. In our last video, we had seen an example of a gold 20 years data wherein the gold growth of the value of gold has gone up. So the inflation is supposed to happen in an economy if an economy has to grow. But what is the targeted rate at which the inflation can grow is nothing but inflation targeting. So New Zealand was the first country which came up with an idea of this inflation targeting in the year 1989. So this is a background about inflation targeting. Now coming back to the monetary policy, it is a policy by somebody. Who is that somebody? It is by the central government and the RBI together. So what they do, monetary policy is nothing but it is refers to the policy of the central bank with regard to use of monetary instruments which are under its control in order to achieve the goal of specified in the act. So which act we will try to understand later, but the main primary objective of RBI's monetary policy is nothing but to maintain the price stability within an economy while keeping the growth objective into consideration. So if we are trying to reduce the inflation, then growth will be impacted. We have also seen that employment is also related to inflation. So that is the primary objective of the monetary policy. So where does this part come into? It is available in the RBI Act of 1934, which has been amended as late as 2016, wherein the inflation target has been specified as 4% with plus or minus 2% offset. Okay, so this is all about the monetary policy. Now coming to monetary policy committee. So monetary policy committee, it has to be defined somewhere. If it has to be used, it has to be defined somewhere, either in the constitution or in the act. So it comes under the RBI Act of 1934, section 45 ZB, wherein the central government is empowered to constitute a 6-member monetary policy committee, and this decision, whatever monetary policy committee forms a decision, that decision is binding on the banks. So that is what is about monetary policy committee. So composition, when I say composition, so how many people can be, how many people, what is its role, what is its power, those things, composition. So that is also defined in section 45 ZB of the RBI Act, wherein which specifies explicitly it is a 6-member committee, wherein RBI governor forms the ex officio chairperson and deputy governor is in charge of the monetary policy, and there is an officer of the bank to be nominated by the central board. So these are the 3 people who come from the Reserve Bank of India. The other 3 people will be coming from the central government. So central government takes up the appointment of the rest of the 3 people, but it is not that they can appoint anybody. That appointed person should be a person of ability, integrity and standing, having a knowledge and experience in the field of economics or banking or finance or monetary policy. So this is the job description which we can say when central government is appointing a person into the monetary policy committee. So now coming to the framework wherein the monetary policy committee has been formed. So as I have already mentioned, it was as per the RBI Act of 1934, which was amended in 2016 to include this monetary policy, and the objective of this policy is the framework aims at setting a policy rate based on the assessment of the current and evolving macroeconomic situations. So these repo rates, reverse repo rates, the bank rate, these are the instruments which are under the control of this monetary policy committee, which could in a lot of way they influence the economy, they influence the inflation. So these tools the monetary policy framework uses in order to control the inflation within the economy. There is a liquid cash flow within the economy is controlled, and the anchor the money market. So money market is anchored by these factors, which is in turn related to the repo rate. So if, suppose an example wherein monetary policy committee increases the repo rate, which means that the interest rate, the lending rate has increased, which means, what does it mean? Rate of interest which the banks charge on our lending, that is, we are borrowing from the banks, we are taking loan from the banks. When the interest rate goes up, so less number of people will start taking loan from the bank, which means that less number of people will have cash in their hand, which means that the competition to buy a particular good goes down, which will help us in some way to reduce the inflation. So this is how the flow is happening because of the monetary policy committee. Okay, and another thing is, why have we picked repo rate as policy rate? Because as I said in the example, once a repo rate is changed, that transmits through the money market, it runs through the entire financial system, and in turn it influences the aggregate demand within the money market. So that is why the repo rate has been chosen as a policy rate. So this you will have to understand very, very clearly. If you do not understand, please revisit this video. So this is a very, very important topic which I am trying to help you guys understand. So this factor is very important in determining the inflation as well as the growth within the economy. Now, coming to the repo rate, so what stand does the government or the RBI or the monetary policy takes is very important. Coming to the policy stance of the RBI, there are 4 different policy stands which RBI takes care. They are accommodative, neutral, hawkish, and calibrated tightening. Accommodative is a stand wherein the bank, that is the monetary policy committee, is okay to reduce the interest rate in order to boost the growth within the economy. So we have already seen, once there is a lot of money within the market, there is a chances or scope of growth, there is a scope for employment. So that is one thing. In the neutral stance, there is either an increase or a decrease, both can happen within an interest rate. And within an hawkish stance, the central bank's top priority would be to keep the inflation to as low as possible. And the last one, which is calibrated tightening, which means there is no way that the central bank is going to reduce the interest rate. It is in this current cycle, it is planning to increase the interest rate in order to cut down the inflation. So these are the 4 stands which RBI follows when taking a decision based on the monetary policy committee. So this is what I wanted to discuss in this video. If you like this video, please do share and subscribe, and thanks for watching this video. If you want to understand a few more topics, please do put those topics within the comment section so that we would pick that up in our next discussion. Thank you very much. Let's meet in the next video.